So welcome to our first panel. Now also from my side, I have to apologize that I could join you only now, but we are also in the last week of teaching this semester. And there are sometimes overlapping commitments, but now I'm here and I'm happy to meet you all. And I'm also happy to chair our panel on regulating capital markets and macroprudential supervision. And my pleasure is even greater to announce the first speaker of this afternoon, Adrienne Héritier, whom I met for the first time 21 years ago, when she was the first professor whom I've ever met at the European University Institute in a course on case study methods. And perhaps without that course, I would not sit here. And so therefore, it's always nice how often you see each other in a life. And today, it's my pleasure from this position to introduce you, Adrienne, still with the affiliation of the European University Institute and the Robert Schuman Center, and your paper on governing finance in Europe, a centralization of rulemaking. And I'm as curious as everybody here is, and we are looking forward to your presentation.
It's a great pleasure to meet you again after, many times in between these 21 years. And thanks so much for being able to present now the results of our research, which was funded by the Swedish Research Council on governing finance in Europe. And this is actually the result of this research, which lasted 4 years. Are two books. The first one is on governing finance in Europe, a centralization of rulemaking as a question. If maybe, Vincent, you could pass the slides, go to the next slide, where we ask, how did first research question is, how did the regulatory structures develop in the EU since the financial crisis? Can we see a direction in the centralization of regulatory structures, a decentralization, or a fragmentation? And what are the underlying political dynamics of such developments? And our empirical assessment on our question we raise is based on MiFID 2, actually, and MiFIR 2, capital markets in general. Now, the research question 2 in the second volume then deals with now the regulation of European finance. What are the policy effects? Who gains, who loses from these regulations? And what about the political and administrative accountability channels, which can be used in the case of discontent with these results, policy effects? Now, I have to say, because of the shortness of time, 10 minutes, I'm not dealing at all with the second research question, but going straight forward into the presentation of the results and the arguments of the first volume. Now, in order to answer this question regarding centralization, we took a wide perspective because it was clear that we can't just look at kind of the vertical European level, right? Because what's happening in the regulation of financial markets is, of course, internationally embedded. Therefore, we take first the perspective of European legislation in the context of international agreements. Second, a horizontal perspective, international perspective, that is a competition between regulatory powers. Thirdly, we look at how does the interaction between private self-regulation and public regulation interact, and how does it impact regulatory structures? And fourthly, we take the perspective of technological digital innovation and its impact on regulatory structures. So let me just turn to each one. So the first one, vertical international research perspective. Of course, European financial markets regulation is embedded in international financial agreements, G20. Therefore, there is pressure coming from the international level, and there are regulatory expectations to which the European Union has to react. And in the sense of getting into the direction of a harmonization of financial regulation. So the first argument is to say there will be this increasing structural centralization at the EU and member state level due to international pressure from the international level, international agreements. But we have to qualify this hypothesis immediately because it's not as clear and as simple, because what we argue is that we know from Europeanization research, of course, that what's coming from an international level and what is then processed at the European level is then kind of again processed at the national level in the political processes at member state levels, and with their different economic, institutional, and political traditions and legal traditions. Of course, we would rather expect that the outcomes of the implementation of the international regulations do not result in uniform regulatory structures and policies at the national level. And to turn immediately to the empirical findings in first chapter by Jan-Katrin and Macroprudential, we find that in the case of high-frequency trading, the Commission takes indeed important steps to comply with the G20 agenda, to engage in a regulatory centralization at the European level, and with the intention to acquire more supervision power for itself, which it does get. However, what we find empirically is that it is more complicated, that the European Parliament also joined these endeavors in order to favor a centralization and control member states in their activities in this particular area. We further found in this first chapter of the vertical centralization perspective that it's not quite true that all the pressure came only from the top, but we also find what we find in this kind of argument of regulatory political competition is that member states try to kind of transpose their own policy approaches to the European level. And in this case, it's Germany who already had such a regulation, which is then kind of uploaded to the European level. And maybe the most important finding which came out from this particular perspective of research is that we do find a formal centralization in policy formulation, but we don't get it in policy implementation. For instance, we have a very strong centralization in the definition of technical standards but what we find in member states, very divergent practices and surveillance structures due to their different institutional, economic, and social legacies. Now, in the chapter focusing on capital markets, CCPs, Capital Market Union, in particular CCPs, by Bulfone and Smolenska, again, we find this argument, of course, which you have throughout the book, is Commission sees the opportunity of international pressure to initiate centralizing legislation, which was made easier after the Brexit decision. And indeed, we find there a centralizing attempt of the Commission and ESMA, but again, which is not kind of, isn't just accepted, but is challenged by claims by the European Central Bank to exert control over the market itself, which again was contained by opposition of the European Parliament. Now, in the empirical finding, we find a clear centralization as regards third country CCPs, central counterparties, but not in the internal regulation. And there is where the impact of Brexit comes in, because particularly France and Germany and also the Netherlands to some extent compete for, in a way, what could be taken over from the UK CCP's function. What is confirmed in this chapter also is that we have a centralization in policy formulation and a decentralization in policy implementation as we found in the first chapter on high-frequency trading. Now, the horizontal perspective looks at the competition between the big regional regulatory powers. That is, we focus on the EU and the US, and we've asked, does that have an impact on centralization of regulatory structures within the EU? Maria Sola argues that indeed the regulatory rivalry between the EU and the US in OTCs led to a fragmentation of the overall international regulatory structure, which then in turn led to a regulatory arbitrage by the regulated industry. And this in turn had as a provoked reaction on the part of the regional polities, that is EU and the US on the other hand, led to a certain centralization of the regulatory structures within one regulatory power to better coordinate its policies given the external competition. Now, we argue that when you ask how do they react, the two regulatory powers, when do they coordinate their regulatory prescriptions? And we argue that if one of the parties takes the lead in this coordination, you could see some kind of progress on the basis of strategies of regulatory equivalence or mutual recognition. That's the argument. And we find but little progress to that effect empirically as regards the agreements between the US and the EU. The negotiations are complicated by the Brexit decision and the issue of how to regulate a third country, CCPs. Altogether, clearly ESMA's powers has been strengthened regarding the regulation of third country CCPs operating in the EU. Now, the additional perspective we focus on, because in financial markets, private actors always played a very important role for centuries. So we kind of ask also, how does the self-regulation of industry, how does it impact upon the regulatory structures? And we first argue that indeed, often new financial products are being developed by industry and then step by step are being subject to regulation by public actors, which then would lead to a partial centralization of structures. We focus in this chapter by Jan-Pieter and myself, particularly on the International Swaps and Derivatives Association with their regulatory activities in the area of derivatives regulation. And the master agreement, of course, of ISDA has been almost, you could say, a global legislation as regards derivatives. But then, after the financial crisis, this was very much contested because of the financial crisis, and more kind of interventions of public actors were deployed. And we found then in the analysis of this political process that ISDA as such was quite in favor of a certain centralization of rulemaking through European action, because it operates transnationally. Therefore, it has also an advantage as regards the homogeneity of rules in this particular field across different jurisdictions. But what we found very clearly is that in the first instance of what you could call the formulation, the policy formulation, they were very kind of went along and supported the action. But as soon as it came to the kind of definition and specification of details of the legislation, that's then when ISDA kind of clawed back power in order to protect its particular clienteles by giving them special conditions in the operation of the market. turning to the last perspective, which is
yes,
then
2 minutes, and then thank you.
Yes, yeah, I'll manage. What we found here is that the digital innovation is linked to the type of uncertainty linked to a new financial product. What we find, I got turned exactly directly to the findings. If we have a lot of substantive uncertainty, we find a lot of cooperation between the regulators and the industry, the fintechs, bespoke regulatory requirements, sandboxing, etc., which lead to fragmentation, which then is kind of treated again with attempts of seeking a certain convergence. If you have legal uncertainty, the policymakers, political decision makers try to exploit pre-existing rules as regards, for instance, data protection, as regards now the type of where you actually don't have any uncertainty as a regulator, which is if you use the so-called RegTech, because RegTech actually allows you to observe each financial transaction like in a meteo system observing the weather, so that you can see immediately does it abide by the rules or not. But of course, not all regulators have this important and expensive infrastructure. So what we found, did not anticipate as a factor, is that in a way the data conciliation by ESMA across the borders, because they have huge amounts of data which they collect, gives them power, de facto power, which they don't have formally. So that means, to conclude, despite of extensive European regulatory reforms, national authorities still have a considerable degree of de facto regulatory power. So we have all patterns: centralization, decentralization, and even fragmentation to some extent. Thanks for your attention.
Thank you, Adrienne, for making the effort to condense such a strong argument in so few minutes. Thank you very much. We will discuss everything later. We have decided to hear the papers in a row, so that I now give the floor to Katja Langenbucher and colleagues with their paper on BaFin independence, dependence, a policy proposal. And we are looking forward to that.
Yes, I think I'll take the floor because we agreed that Patrick Blank and myself were going to present our paper very briefly.
Great, thank you.
I'll share my screen with you, which you should see now. Okay, thank you for the invitation. Thank you for giving us the opportunity to present to you and discuss with you some of our thoughts on the future of BaFin as a securities market supervisor. What Patrick and I will present to you today is the result of an interdisciplinary collaboration with Katja Langenbucher and Jan Krahnen. And we hope, dear Katja and dear Jan, that we will not distort any of our findings. If we do so, please do correct us afterwards. In the paper that we're presenting today, we address the question whether it is possible and whether it is desirable to grant BaFin independence from the Ministry of Finance in the field of securities supervision. Insofar as BaFin acts within the framework of the SSM and supervises banks, it already operates independently. This is required by European Union law. However, in all other areas of its activities, and namely in the field of security supervision, BaFin is itself subject to a supervision, and that is the supervision by the Ministry of Finance, which controls both the legality and the appropriateness of BaFin's decisions. And this means that major decisions in BaFin's supervisory process either need prior ministerial approval or can be altered by the ministry retrospectively. And it also means that the ministry has the possibility to superimpose its own short-term political goals over pure, as it were, law enforcement. Ultimately, this implies that the ministry can prioritize its position over that of the parliament, which is, after all, expressed in the law. We believe that in order to strengthen the German capital market, it is desirable and also constitutionally permissible to change the situation and to grant BaFin more independence. Why is more independence for BaFin as a securities supervisor desirable? Oops. Capital markets are becoming increasingly important for economic development, even if in a bank-based system like in Germany. Functioning markets depend on reliable information about market participants, and regulation and supervision therefore need to ensure that value-defining information is disclosed promptly and fully to investors and to the public. This is a prerequisite for efficient price formation and is the basis for investor and issuer confidence in the integrity of the market. Economic research has shown that stringent rules and reliable enforcement have a positive effect on capital market development. Investors will learn that rules are dependable and trustworthy, which allows them to allocate capital confidently for the longer term. On the flip side, especially the Wirecard case has made it clear that inadequate supervision jeopardizes investor confidence. As far as BaFin's independence is concerned, it is important to emphasize that doubts about the reliability of the supervisory process can arise simply from the fact that the ministry has the possibility of intervening to protect national interests or in the interest of nationally important firms, regardless of whether this then later actually happens or not. However, independent authorities are still the rare exception in Germany today, unlike, by the way, in most other European countries and in the US, where they are part of everyday administrative life. And this brings me to the second question we address in our paper. Is it constitutionally permissible to grant BaFin independence from government instructions on law enforcement, which is what we call in German Weisungsfreiheit? Our constitutional reasoning is illustrated by this figure that you can see now and which is also in our paper. In a nutshell, the argument goes as follows. All public officials must have a sufficient level of democratic legitimation. And this level of the democratic legitimation is composed of personal and legitimation in functional and substantive terms. The abolition of the ministry's right to issue instructions reduces an authority's democratic legitimation in substantive terms, because the government then is no longer responsible for what the authority does, and Parliament no longer has anyone to hold accountable for when the authority fails to fulfill its duties. Therefore, an independent authority is legal only under two conditions. One, the decrease in influence needs to be compensated for. And two, there needs to be a specific justification, ein besonderer Sachgrund, in the words of the German Constitutional Court, for granting independence. Now, is there a specific justification for insulating BaFin as a securities market supervisor from the federal government's instructions? We believe, yes, there is. We submit that for BaFin, this justification may be delivered along the lines of a dangerous combination of an incentive to unduly step in and the opportunity to do so. Economic research has shown that there are a number of incentives for government officials not to align securities market supervision exclusively with investor protection and market integrity. And Patrick will elaborate on this in more detail.
Yeah, thank you, Ann-Katrin, and thanks to the organizers for the invitation. In our opinion, there are three major reasons why market supervision should not be bound by government instructions. The first important incentive is basically identical to the justification why independent central banks are better suited to maintain price stability, and that is political actors have an incentive to manipulate economic aggregates in the short term in order to improve their re-election prospects. Now, unfortunately, we cannot give evidence for such opportunistic behavior because we lack enforcement data from Germany. However, we can draw on empirical evidence from the US, suggesting that there are indeed electoral cycles in SEC investigations, which are even more pronounced when financial penalties are likely to cause negative employment effects. So for instance, when congressmen or women who are in charge of the SEC oversight rerun for office, the SEC is less likely to challenge companies based in their home constituency. Second, there's a home bias, and the pointed issue is that financial information has public good character, and therefore national interests do not internalize the benefits from more vigorous enforcement activities to investors who are spread around the globe, which leads finally to an under-provision of enforcement efforts against domestic firms. And what is more, the incentives of the government and the supervisor in this case are aligned, meaning that as a corollary, so to speak, direct political control by the executive branch in general is very unlikely to provide useful feedback for the supervisor or deliver on its role, because the government is always very unlikely to behave like a social planner. And finally, there's of course the case that pivotal political institutions are captured by private sector interests. Again, from US experiences, we know that fraud at companies with strong political ties is less likely to be detected, and detection is not only delayed by days, but weeks or months compared to non-lobbying companies, which has, of course, huge negative welfare implications. And this is why Ann-Katrin will now show us how to tackle these three issues. You are mute.
Yeah, I unmuted myself. What we're supposing to do, what we are suggesting as a reform, is both. It's an answer to those three incentives, and it is also an answer to the constitutional requisites. Because additionally to the compensation for decrease in influence, additionally to the specific justification, you need a compensation for the decrease in influence. And to this end, we propose to add to the already existing strands of democratic legitimation, which is judicial review and the mutual control within the European financial system of supervision. We propose to introduce a reporting and accountability obligation of BaFin directly to the German Bundestag. And we propose to grant reporting obligation, and we propose to grant members of parliament the right to ask questions directly to BaFin, which they don't have so far. Only in June, in a response to a parliamentary question, the Ministry of Finance announced that it would, I quote, examine in detail the question of a fundamental adjustment of BaFin supervision, and that it would, and I quote again, with some, well, I'm getting a little flushed, and it also said it would also take into account the proposals of SAFE, which are our proposals. So we are very excited to see what follows, and we look very much forward to the discussion, and thank you for your attention.
Thank you very much, also with this nice cliffhanger towards the end. And we have the third paper in this panel by Matthias Thiemann from SciencesPo in Paris, but I guess he is not there, if I interpret correctly the surroundings. And he will talk to us about, you can see it, counter-cyclical macroprudential policies in the EU before and during COVID. Matthias, the floor is yours.
Thank you very much, Claudius. And let me start by saying that I'm really honored and very happy to be on this panel. And I think there's plenty of things to debate, and hopefully the panelists also have some time to discuss among each other. Exactly. What I would like to present to you today is macroprudential regulation, in particular the case of anti-cyclical real estate regulation. In order for you to know what I'm talking about, I hope that this slide will move. Yes. And so I would like to first introduce you to macroprudential regulation, if you don't know yet, which is maybe arguably the largest post-2008 change to financial regulation, which is driven by the conviction that financial markets are prone to boom and bust cycles, which is indeed quite a shift in the ontology of financial markets as regulators perceive it, and which therefore seeks to intervene in these boom and bust cycles to dampen these tendencies. That is to say, if a financial boom is detected, macroprudential regulation is supposed to intervene anti-cyclical to cool the boom. And when there's a bust, such as the COVID crisis, arguably, regulators are supposed to intervene anti-cyclically again to do everything against this bust. And in this field, real estate markets are seen really as at the center of it, because they're particularly prone to such cyclical overheating due to speculative behavior both by individual persons, the famous flippers of the middle class, but also institutional investors which search for yield. And here it is not only the United States that before 2008 went through such a boom, but also Spain, Ireland, and Portugal, which before 2008 really had a housing bubble that resulted in many, many buildings being built that in the end would not be used, but also strong price appreciation, and in the bust, strong price depreciation. And so if anything, one can argue for the European Union that anti-cyclical regulation, the intervention in this development of these boom-bust cycles in the real estate market are really crucial. Why is that? Because the European Union, due to its treaties, is an area of free capital flows. That is, no country can tell any other country not to bring in money, but it has markedly different returns on capital that it's offering, which has also to do with inflation rates. And therefore, one could argue, and I will argue here, that the evolution of these real estate bubbles in Spain, Ireland, and Portugal before the crisis was not a coincidence or an accident, but it was indeed an outcome of an area of free capital flows with different returns. And these cyclical developments, they threaten the European Union as a whole, because these when a financial bust arguably, inevitably comes around, and the banks have to realize the losses on the mortgages that they have given, this threatens to undermine national banking systems, which threatens to undermine national sovereigns, which in turn threatens to undermine the European Union. Now, that's the reason why in this research, which I'm undertaking jointly with Bart Stellinger from the University of Amsterdam and Etienne Lepers from the OECD, we're looking at the real estate action on real estate by macroprudential agencies between 2010 and 2020. Or 2021, if you like. And we're investigating how these macroprudential agents actually intervened in the buildup of real estate bubbles. Now, for those of you who do not follow real estate markets with as much fervor as I do, one can say that from 2016 at the latest, in about 17 countries of 27 in the European Union, a real estate bubble has built up. And we are investigating essentially how these 17 countries reacted to that. Now, when we speak about the implementation of macroprudential regulation in the EU, you'll probably know that there is a macroprudential instrument set that was installed with the translation of Basel III into European law. In particular, the counter-cyclical capital buffer that is supposed to be raised in a boom and lowered in a bust. Article 458, which allows national discretion to banking regulators to increase risk weights, and since 2014, the top-up power by the European Central Bank, which is really has been the cause for much legal discussion in how far the ECB can top up measures that, for example, have never been activated by the national level. So I think it's fair to say that we are really faced with a decentralized macroprudential architecture, which has been implemented from 2011 onwards. The first step here was the formation of a European Systemic Risk Board. which, however, has no binding power. It can only issue recommendations and warnings, and then functions on a comply or explain basis. So you have to imagine, for example, a country such as the Netherlands will receive a warning in 2016. It looks like your real estate markets are overheating. Please explain to us what you would like to do about it. And the very first recommendation by the European Systemic Risk Board was to set up similar bodies nationally to enact these domestic macroprudential decisions, which is essentially what has happened since then. And so every country today has a national competent authority, often the central banks, but also often financial stability councils, which bring together the central banks and the ministries of finance, and in the case of Germany, the financial supervisor, BaFin, that we just heard about. And so when we look at the literature on macropru, where do we fit in? And this is on the first there's a general literature that was very enthusiastic about macroprudential regulation initially in 2013, Andrew Baker, for example, and then becomes somewhat deflated and disappointed because the implementation is really limited. And in this context, Baker has pointed to the macroprudential conundrum, which I think is something that we keep for ourselves, which is what is so important about these issues, such as the intervention in housing markets, and here we're really talking about stuff like measures that constrain the access of people to housing, is that it is a distributive decision. It is therefore a political decision, and it requires therefore political backup and strong political backup. But at the same time, the strong political backup is not likely to be forthcoming in a political economy that lives from the growth of credit, so that is dependent on credit growth. And so the question is, in a sense, how does technocratic expertise that analyzes these emerging systemic risks on the one hand, and political decision-making, such as it is located in the Ministry of Finance, come together to effectively face these financial booms, or in this case, this real estate booms that we've seen since 2016 in many, many European countries. The political science literature really just focuses on the setup and the negotiations of this. The same goes for the regulatory literature, but there's really very little literature on actual macroprudential policy making. So not only looking at how this thing was set up, but also how it is actually brought about. What all these literatures share in common is that they focus on what is called the inaction bias. So they are, this is a concern shared by policymakers and the literature, which is that national policymakers will tend not to act. And the question is, how could this be set up in a way that there can actually be some action on these housing booms? Now, when we look at these cyclical developments, and here we really use the European Systemic Risk Board to inform us, we can draw out that 17 countries in the European Union did experience, or actually, as we know today, still do experience a cyclical upswing in the real estate market. So much so that 11 of these countries have received a warning or recommendation, which by the way is worse, a recommendation to act on these housing markets. And so what do we do in this project? On the one hand, together with Adrienne, I've coded, or we are coding, he has mostly coded all macroprudential measures of these 17 countries, and we're scaling them and performing qualitative comparative analysis, such as you've heard earlier by Andreas et al. And here I can already tell you, crisis experience, political salience, but also the institutional setup matters. And then as a second one, Bart Stillinger and I undertake a process tracing of 3 countries, Netherlands, Germany, and France, which have received a warning, and where we have undertaken 18 expert interviews with actors in these spaces to understand if and how they come about. And what follows, I will mostly talk about this study. So in these 3 countries, the first thing that we find, and for those of you that are actually involved in policymaking processes, maybe it's not such a big surprise, but we found that there is lengthy debate. So that is to say, in these financial stability councils that exist in France and Germany and the Netherlands, we find debates that precede the final decision-making by several years. And it's usually the macroprudential change agents, the central banks that push for measures. And it's usually the ministries of finance and the supervisors that oppose. And so in the end, we find the decisions are taken in 2019, including borrower-based measures in France, a small raise of the counter-cyclical capital buffer in Germany, and really a minimal risk weight changes for mortgages in the Netherlands. And how can we explain this variation? Well, our first argument is that the way that these financial stability councils are set up is really crucial, makes a crucial difference as to how these debates unfold. So we are observing here how the political and the technocratic come together. And the way that it's done in France, and I had very interesting interviews there, is that the Ministry of Finance is bound up in the process in such a way that the Banque de France not only has the right to issue its recommendation on that something should be done, and it can do so publicly, which has the capacity to impose pressure on everybody involved, but also that the Ministry of Finance can be outvoted. That is to say, if the change agents on this board decide that something needs to be done, even if the Ministry of Finance opposes, which in the end it didn't, but it can be done. Okay, in Germany, the Ministry of Finance, which is together there with the supervisor, BaFin, dominates. And really what we find is that for a long time, BaFin contradicts the claims by the Bundesbank that issues are arising, dangers are arising. BaFin is also legally very insecure about how to use this instrument. And it takes several years in order to convince, in order for the change, like macroprudential experts to convince the Ministry of Finance that something needs to be done. And still, when something is done, it is very minimal. Pretty much every bank in Germany has no problem in fulfilling this 0.25% counter-cyclical capital buffer. And it's something that is mostly done to be able to say later if something bad happens that something was done. So it's symbolic action.
2 minutes, please.
Oh, yes, with me it's 2 minutes. Okay, so in the Netherlands, the Ministry of Finance is not bound by the Financial Stability Council. And so it basically receives many recommendations that it should do something about the housing market, but it says, well, we will not do anything. In this context, we find that the European Systemic Risk Board helps with its recommendations and warnings. And we actually find that several of these change agents domestically instigate the European Systemic Risk Board to issue warnings. But if the Ministry of Finance is not properly connected in this Financial Stability Council, nothing happens. Additional reasons we identify is the political salience of housing, which is particularly important in Netherlands and in Germany, but also some concern over the low income of German banks, which is an issue that particularly holds for BaFin. And that's a comment for the people speaking before me. I think the capture by finance regarding BaFin is more of a serious problem than the capture by politicians. So actions during COVID, I have 1 minute. It's quick, active, and massive. And yet, I will show you a graph in a second, and yet the house price increases that were worrying the European Systemic Risk Board so much have not slowed down, but actually risen during COVID. So they're much higher, 5.8% on average in 2020 versus 4.3% in 2019. And the real question that I think that we face today is, how will these macroprudential agencies face this? And this is just to show you everything that is below the bar, everything that is below zero is a sign of easing. So we have a lot of easing since 2020 March. And so to come to a conclusion is the same graph, and I'll come to my conclusion now. What do we find is that anti-cyclical intervention in the boom is very difficult, in the bust is very easy. So it's very asymmetric. And so we think that the current architecture of coordination is very weak, that the ESRB helps, but it's not strong enough to steer. and that we're actually facing a serious risk of housing bubbles, if we don't have them already, that they are blowing up right now, and bubble bursting this time in the center of Europe, not so much in the periphery. Thank you very much. That's it.
Thank you, Matthias. And now we have comments from the discussants, and afterwards the general discussion. I saw already some comments in the chat, but in any case, I now give the floor to Barbara Brandl and Matthias Goldmann from this institution here, from the Goethe University Frankfurt, for their comments.
I don't know who want to go first. My comment, but maybe I go first because my comment is to the paper of Matthias Thiemann et al. So I start, and I'm very happy to comment this very interesting and highly important paper. I think it's so important because you explained it in your paper that all this policy making, especially macroprudential policy making, it's highly influential to the general public, but it's usually very opaque. So we don't have access to this. And when you have this interviews and also, I think it's very important that you go in this area. I have three questions, minor question, and one kind of personal recommendation, what I would be interested in. My first question is, normally we see a very strong correlation between housing prices and the prices of money, so mortgages, but we don't see this at least not in Germany. I don't know that well about France and the Netherlands, but we don't see this correlation yet. And my question is, what is your intuition? Why don't we see this? And what is the implication for financial stability that we don't have, that the prices for mortgages going up at the moment in Germany? Second question, I was very much reminded, I call it the return of the Keynesian dream. So we have this stability board with all the data, and you describe it in your paper very well, how cumbersome it is to gather all this data about the housing market. And then we have one central board which makes decision about the whole economy, and especially the housing market is very regional specific. So how do you make sense of this? That we now think again that one central body can decide. I know this is a dream of all this macroprudential thing, but for me it's something like the zombie Keynesian dream comes back. And second question is about your cases. You have France, Germany, and the Netherlands. I'm no expert in the housing market, but I know that, for example, Sweden, they picked up this specific, the cutting of mortgages that you have to pay back sooner. So why didn't you include in your cases Sweden? I think there's another country who did this, who made regulations. These are my minor question. And now I have, I would be very much interested in the implication, or for me at least, it's not clear what groups, what classes in society have which interest in this. So I can think about old against young, because, for example, I only make when you cut mortgages, young people don't have access to buying houses. So maybe there's old against young, is it rich against poor? Because to me it's highly unclear which group and interest here against each other, and I would be very much interested in laying out this in your paper. Yeah, thank you.
Okay, thank you, Barbara, for being so concise. Let's ask Matthias for his comments, Matthias Goldmann for his comments. I have to be very clear. And then we open the discussion. And at the end of everything, the authors will have a few minutes to respond then. Yeah, so Matthias Goldmann, please.
Thank you. My comments on Adrienne Héritier's paper will be a bit short because I didn't have so much time to prepare in that regard, but I found it a very wonderful and very enriching paper and discussion, and I'm looking forward to hearing more about it because it addresses a key question of the European Union in general that we see like under a magnifying glass here in the field of capital market governance, which is the problem between centrifugal and centripetal tendencies and how we can organize that in a political multi-level system. Now, my first question to you is, since centralization comes almost inevitably with these centrifugal tendencies, wouldn't it be worthwhile considering to centralize not just regulation or not just legislation, and then decentralize regulation to some extent and decentralize supervision even more? But wouldn't it be conceivable to follow a little bit the model that we have in antitrust law, where we've got a centralized, fully Europeanized administration for the big stuff, for the important mergers and cartels, and the not so important peripheral stuff can go to the national administrations. So wouldn't it be better to have a hierarchical structure for instead of this layered structure where you always have these losses? I'm just thinking about banking supervision, which is much more consolidated than capital market supervision. And even there you have all these divergencies and they come up inevitably because there's so strong interest, to get a national advantage, etc. Second question, ISDA. You're presenting the ISDA as a good citizen here. My question is it really that good a citizen that, voluntarily cedes some of its power? Didn't they gain enormous power by becoming, so to say, the quasi-official legislator, by, getting a license, more or less, this is a non-technical expression, that their standards will be the official standard? I think that is something that that is not the first time to happen, that for a private actor, it is like the peak capture or the peak of lobbying success, so to say, that their standards get recognized by the government. And perhaps this is the case now for ISDA. Third question and last question, fintech. I find this idea of uncertainty interesting, that you play or you make that responsible for the centralization that we have. But isn't there also another story that we have got a lot of competition going on between existing regulators or supervisors basing their decisions on existing regulations, so that there is first, a decentralizing movement, everybody trying to gain an advantage and presenting itself as a better location for fintech, for cool, promising fintech companies, and then the EU needs to chime in and secure some level of order. So I think it seems to me that there's a lot of Becker neighbor in the background. So much on my comments to this project by Adrienne Héritier, which again, I really find very worthwhile. Now my comments on the paper, on the Langenbucher EDCO paper. Now I really like the idea of rethinking the position of BaFin. It's absolutely necessary after the scandal. Not the first scandal of BaFin, by the way. And I also like the idea that you're presenting an absolutely counterintuitive solution. Yeah, so I think we can agree, whatever the role of the ministry, that BaFin really messed it up here. Like taking legal action against journalists when they were absolutely right. And what you want to do is basically to reward them with independence. This is a bit provocative. I do take that seriously, but I think it should give us the occasion to look a bit more closely at the underpinnings of independent regulatory institutions. Let me first I've got 3 points, I'll hurry up a bit. Let me first take a historical perspective. Now, your analysis seems to me to be rather focused on this period of, mid-70s to mid-90s, which one might call the golden age of independent authorities. If we go back in history a little bit, things might look different. This idea of bureaucratic rationality recalls, of course, the work of Max Weber, who basically thought that bureaucratic rationality might to some extent replace the lack of democratic legitimacy. So it was a policy conceived out of big mistrust into politics, and that had an impact on the Weimar, on the Weimar Constitution, which, by the way, was the most democratic, the most progressive and the most modern constitution of its time. And it failed, amongst other factors, because it could not rally the support of social actors. They were given too much independence, and it could also not rally the support of large parts of the bureaucracy. That varied a bit during the 12 years of the Weimar Republic, but on the whole, I think it's fair to say that they could not rally the support. And they, this idea of an independent rule-obeying administration was incredibly strong, that it really outperformed democratic government and parliament in the eyes of the public. We know where that ended, but it's not the sole factor that led to National Socialism, but I think we should not underestimate the capacity of that to undermine a democratic, a liberal democracy. Yeah. Now, this idea of independence got a much more positive side since the 1970s, when Bundesbank was very successful in implementing that policy and stabilizing inflation. And then it was constitutionalized in the 1990s. By the way, here only the Maastricht judgment is really the relevant one. You're citing many judgments like from the 1950s. I think they're not so relevant. I think what is really relevant is the Maastricht judgment, which says, because before then, independence had not any constitutional status. The Bundesbank was just independent on the basis of a simple law. And the constitutional status was only given with the Maastricht judgment, because in the Maastricht judgment, they said, okay, the European Union is not really democratic enough to get monetary policy competencies, only if you give it to an independent expert institution. And that really constitutionalized it. So that's responsibility of them. And then, let's look at the performance of independent institutions in the 2008 crisis. I think that is really an important background research that should be done here. Some of that has been done already here and there, and I think what we can say is that it's very difficult to say that independent institutions generally did better than non-independent institutions. Just think of the Federal Reserve, which clearly, whose monetary policies clearly had an impact on the buildup of risk. Now, so much on the history. So historicize that to get a grasp of the value of independence. The second point that I have is really, what is the value of independence nowadays? Now that we're moving from neoliberalism to a system that some call state capitalism, that I would call integrative capitalism, because it also involves a strong market element. But times are different. We're not in Kansas anymore, so to say. Now, let me go to the main justification for independent authorities. That is time inconsistency. How did that change, or what's our changing perspective on that? I think time, if we just look at the field of monetary law, you've got a much harder time in justifying time, or in using time inconsistency as a justification for independence at the zero lower bound. Because what's independence worth there? It's there. Everybody is moving into a policy that something is inflationary. We still have no inflation. We're not likely to get any inflation, any long-term inflation, except for local and small temporal events at any time. So a central piece of this justification of independent authorities in the most important case, which are monetary policy institutions like central banks, is fading. It's crumbling. Yeah, I think that the similar point could be made for supervisors. Why wouldn't supervisors need independence? Is time inconsistency really that much of a worry in a time where we have got much more public investments and much more industrial policy? We've got a return of industrial policy. Industrial policy was anathema for 20, 30 years. It's now forcefully on the return, and not just in China, also in Europe. Take Next Generation EU. So doesn't that really, when the state is an investor, doesn't that really change fundamentally our framework? Because this whole idea of independence relies on a predominance of market structures. It's really based on a market-only model. And when you have a much more important role of public actors in the economy, I think it really changes the equation quite That brings me to the second point.
Which you have 2 minutes.
Okay, I'll try to hurry up. Political influence and spillover effect. Because of this changed situation, monetary policy at the zero lower bound has enormous impacts on economic policy in general. That is consensus now, and that even has gotten the legal blessing of the Bundesverfassungsgericht in the PSPP judgment. That is what they meant ultimately, or what they effected with their idea of proportionality. And if you consider this enormous political influence, then independence poses a much greater problem for democratic legitimacy. So the hurdle to justify democratically is much higher. And that is why now we have a debate how the independence of the European monetary, the ECB can still be justified. That is a parallel debate to your case. And many people say, you know, somehow ECB needs to align itself with policy. And I'm missing that debate here. I'm missing that debate in your paper. I don't say that this debate is right. I don't say that there's no case for independence anymore. I had a few points on why I think there's still a case for independence. I'll probably not be able to conclude that, but I'm missing this debate that at the moment, the trend is really from independence towards policy alignment, I would say. And if I read your paper, I don't see that reflected. It's almost a little bit like, you know, two discourses that are interconnected, even though I think they have a lot to say to each other. Maybe my last point, if I may do so, some doubt as to, I have some doubts as to the capacity of the law to guide independent authorities. Now, this is an idea that really comes from Friedmanian monetarism, and that is very well reflected and theorized in Hayek's work. But it really has, as a backing, this idea of a mechanical application of the law. And what we see now, whether you look at monetary policy, whether you look at fiscal policy, or as I would claim, whether you look at financial market supervision, the application of the law always involves a lot of discretion in a non-technical sense. I know the Germans distinguish between discretion and interpretation of the law, but everybody else doesn't do that, and that is because, you know, discretion is discretion ultimately. So you cannot really have rules implemented at a certain time, expect to govern a situation a long time down the road under fundamentally different circumstances, yeah, and in very specific situations that you cannot foresee and that you could not foresee because we live in a time of permanent crisis. This idea of regularity is kind of a precondition of any rules-based framework, and I don't think that this idea of regularity still persists so much. Maybe so much on this critique. I think we really need to rethink the model or the value of independent institutions in a very profound way. And then maybe on such a model of such an, I would say, overworked idea of the value of independent institutions, we could base the idea of build the idea of an independent BaFin. I do think that there's a point for independent authorities. I only think this is a little bit different. It would perhaps secure a BaFin that would, a BaFin that would be free from some of the ills that it currently has. One of these ills is, you know, this overly legalistic approach, and that they're lacking somehow the economic overview, or a bit along the lines of what Matthias Thiemann said. And by making the BaFin an independent yet law-obedient authority, I don't think you achieve that. You only achieve it if you make it like a bit like the Bundesbank, yeah, not so law-guided, or only vaguely guided by the law. But that then again, in turn, raises many questions of accountability, and you discuss some of them. There are some proposals. I find these proposals as such very interesting. I would only
Since you mentioned the word questions,
yeah,
in order to permit to the others to ask questions, final sentence, and then we open the floor.
Okay, last point. I would only recommend to maybe look a bit at the research that has been conducted on monetary policy dialogue and banking dialogue in the European Union. Fabian Amtenbrink has great papers on that, and the results he gets are very mixed. So parliaments are good for some ideas of for some ideas of accountability, but maybe not so good for others. Yeah. Anyway, thank you so much.
Thank you very much. So the floor is open. My idea is to collect some questions for 10 minutes or so, and then to give to the panelists the possibility to respond 5 minutes each. So some of the questions are already in the chat. So since we all learned multitasking, whatever, panelists will certainly be able to listen to the questions and read through the chat. But are there any questions from the audience? So please raise your hand. I should see that somewhere. Who wants to ask something, to say something, to contribute something?
Yeah, maybe to interrupt here. I mean, the few people who had questions in chat, I think Matthias Thiemann had was, and Andreas Nölke, Eckert, maybe they can post the questions now and to the speakers that they have built on what we've heard. And yeah, thanks. But thanks for the question in the Q&A. Maybe to whoever this is addressed, we can go through this a bit. Michael, there's two questions regarding BaFin. Would subsuming BaFin to the Bundestag not very much complicate its position within the European supervisory debate, i.e. as a part of ESMA? So this goes to the BaFin paper too. And then regarding, now he's also here, so maybe we can let him do it himself. Hi, Michael.
Basically, the flesh of the question is already what I put in the Q&A. Concerning the first, is just my impression that at the Central European level, that we have some control of the supervisors by the Commission, by the Council, by the European Parliament. Now giving opening parliamentary scrutiny to BaFin, I think it will make the life of BaFin in the European supervisory discussions very, very difficult. So that this seems to be a strong downward factor. And regarding the centralization of financial regulation, I must admit that I work in the European Commission, and of course we play with the toy of legislating more through regulation than through directives in order to get this implementation national bias a little bit out. There was a public consultation on this just a few months ago, and it was not really conclusive on this, whether more regulation would really be helpful, and I would therefore be interested in your view, whether you find this a favorable way forward. Thank you.
Okay, more questions. I see Andreas Nölke has unmuted the microphone. Is this connected to a question?
Well, yeah, I had put it in the chat, but maybe I can simply read it because maybe not everybody can see the chat. Is that possible? Okay, so I just read it out. My question was to Ann-Katrin and Patrick. I saw a tension between Patrick's argument in favoring maximizing independence of BaFin, analogous to the economists' arguments about central bank independence, and Matthias Goldmann also has to raise these issues. And then Ann-Katrin on the other side argued in favor increasing responsibilities to the Bundestag. So how does this fit together? On the one side, arguments that independence agencies do best, and on the other side, increasing democratic legitimacy. And then I found very interesting the paper, the arguments about input legitimacy by Fritz Scharf. But I wonder how the other two proposals, integrating BaFin and ESFS and strengthening the administrative council, really help there, because the administrative council, for example, has a substantial participation by the banking sector, and I don't think that is what Fritz Scharf had in mind with his concept of input legitimacy. Thank you.
Okay, thank you very much. More questions? If not, I don't see any questions for the moment. Then I draw your attention to the chat, where you can find more questions by different people, also directed to different people, to different panelists. So without wanting to read them out now loudly, perhaps everybody can have a brief look at the chat, and above all the panelists.
Mm-hmm.
Because then I would simply propose to start again and to give the panelists the possibility to answer to the comments by the discussants, but also to the questions raised now, but also to what is written in the chat. So a lot to do. And therefore we start immediately, and we do it in the inverse order. And we start with Matthias Thiemann, and he has 5 minutes.
Oh, wow. 5 now. Oof.
Yeah, no, I'm generous. I've become generous.
Really kind. Thank you. So, Barbara, thank you very much for the comments, and also for the comments in the chat. I think the first one question that was raised by Ami Verdun is whether I would be able to comment on the recent ECB decision to include house prices in inflation measures. Francesco Nicoli has suggested about time, which I think is a very good suggestion to answer that. It is actually, and that links already to the comments of Barbara, it is at the same time absolutely fascinating to observe how much technocratic work is involved in achieving this feat, because these people now need to differentiate, because for them inflation, right, is the costs of living, and that is to be needs to exclude the gains from speculation, as long as they do not impinge upon the costs of living. So this is, for example, one of these tricky technocratic issues that they're facing. Another one is evidently that they don't have data. This is really a fascinating issue that I couldn't go into enough in my presentation, but many countries don't have granular data on house price developments and different, like, that allows them to really monitor what's going on. And this same problem will now play out on the level of the ECB. So I wish them the best of luck. And I think what we as academics often underestimate is the actual technocratic sweat and pain that goes into constructing such databases. So I think once this database will be there, it will be of great benefit, both for the fact that we will hopefully see and take into account housing developments also in monetary policy, but also for researchers that then can use this database. So in that sense, I think it's a very good development. With respect to the comments by Barbara, so I would like to start first with her big comment, which is the implications, which is what groups and what classes in societies have an interest in this. I think this is partially country specific. But yes, in general, there is a tendency young against old. There is also a tendency rich against poor. So macroprudential regulation, in essence, means nothing else but that the poor can no longer afford the houses because that's the financial stability risk, to put it very, 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 very crudely. And this is also why we see, but this is exactly where the point is with respect to the political tension. And that's where you have these difficulties, for example, when you're trying to code these measures. What we found is that most of the measures have a margin where they say about 15% of mortgages don't need to comply with this. And these margins then are always used by politicians and politics to specify there are 15% of mortgages that shall be given preferentially to the poor or to the young or to both, and so on, you know? And so, and just to be politically clear where I stand, I think macroprudential regulation in and of itself cannot solve the problem of financialized housing booms. And they shall be doomed if they have to do it on their own. But that's the political conundrum that they are facing. I think with respect to the zombie Keynesianism that you're speaking of, you know, I'm from the camp possibly that believes or that wants to believe in accepting the challenge that we can collectively come up with a solution that is better than just letting the market do its magic. As I said earlier, I don't think technocrats in the central banks can solve the problem for us, simply for the fact that we need, I think, social housing programs, and we need social housing programs to come back on a big scale. And coincidentally, France is the country that has one of the best functioning social housing programs in Europe. And that's also one reason why I think the French can act on housing in a way that possibly the Dutch, for example, cannot. Because in the Netherlands, it's an astounding number, 50% of owner-occupied housing, people have a mortgage. Yeah. So, I mean, and as Bart Stellinger keeps pointing out to me, the rental market in the Netherlands is rather broken. So it's regional specific, and that's a good point. Then your comment was on the case selection, and you pointed out to Sweden and to Ireland. And I think that's a very fair point. And these are cases that I hope still I can work on. But in particular, why we chose these three is because they are Financial Stability Council. And from a theoretical perspective, we thought to ourselves, well, if the macroprudential conundrum is correct, in other words, Macropru requires to take political decisions, so it requires political backing, but these decisions will never be taken by political actors alone. We thought that financial stability councils are potentially the optimal institutional configuration to bring about such decision making. And that's why we decided to focus on financial stability councils.
One more minute, please.
Oh, I was actually going to say, I'm done. Thank you very much.
Perfect. So this is a credit for the next respondents. There are also two. That's Ann-Katrin and Patrick. And you have 6 minutes.
Oh, wow. Thank you very much. Nevertheless, I will try to sum up a little bit because there are a lot of questions and I'm trying to a little bit explain what we did in the paper and thereby try to answer the questions and reply to the comments that were made. First, clarification. When we're talking about independence in our paper, we're talking about independence from government instructions. We're not talking about financial independence of the BaFin. We're not talking about personal independence of the BaFin members. Second, and that seems very important. Granting independence to a public authority is always ambivalent with respect to democratic legitimation. Why? It weakens democratic legitimation because it abolishes the government's right to instruct. Thereby, it takes away from Parliament the opportunity to hold a government responsible for what the authority did, and thereby it takes away from the people the opportunity to control the authority via Parliament, government, BaFin. But it also strengthens democratic legitimation. And it does that because if and when the authority concerned can be expected to better perform its tasks, to better fulfill its duties, if it is independent, than if it was subjected to government oversight. And only in those cases, and those are the specific justifications that we're talking about, is independence and granting independence to public authority legitimized democratically and with a view to the constitutional principle of democratic legitimation. Only if we can expect that BaFin will better perform its supervisory tasks if it is granted independence from government instructions, then the exception from the Weisungshierarchie, the hierarchical submission of BaFin to the Ministry of Finance is constitutionally permissible. That is important because it is an ambivalent effect that the independence triggers. Third, Matthias, no one said that generally granting independence to independent authorities will provide better results. Why should I say so? No one ever said that. We said we were specific on BaFin, and we're suggesting that specifically BaFin and financial supervision will be generating better results and will fulfill its duties better if granted independence. Fourth, independence is not in retreat in general, especially not internationally when it comes to supervisory processes. And I refer to a paper that Katja Langenbucher and Jan Krahnen published on request of the European Parliament, and where they have a spreadsheet explaining which supervisory authorities in Europe are independent. And if you have a look at the spreadsheet, then you can see it's not a retreat, rather the opposite. Fifth, small comment: the most important judgment of the Constitutional Court when it comes to granting independence to public authorities is not any longer the Maastricht judgment. It is, at least from my point of view, the constitutional judgment on the banking union, where they specified, of course they referred to the Maastricht judgment, but they specified and they further developed their argument on when public authorities may be granted independence from a constitutional point of view and with view to the democratic principle. Sixth, tension between the arguments pro-independence and at the same time taking it back to Parliament to control BaFin. Yes, there is a tension, it is true. And our reform proposal is the attempt to find a balance and to strike a balance with, on the one hand, the assumption that an independent expert authority will be more apt to conduct supervision. And on the other hand, the necessity, the democratic necessity to have some sort of link back to the people, to parliament. And by having it report to the administrative council, we're thinking that that's a good way to strike the balance, because the administrative council of BaFin is has a mixed composure. We have representatives of government officials, we have members of parliament, and we have representatives on financial industries. So we're thinking that this is a way to strike the balance and to a way out of the tension that you described, which certainly exists. And I think I had a 7th point. Yeah, my last point, because there was a question: is it really capture that was, and was it really a problem of the supervisory process that was illustrated by the Wirecard case? And in order to illustrate that, I'd just like to recall very, very briefly what happened in the Wirecard case. February 2019, FT publishes first information on Wirecard fraud. October, FT publishes large numbers of documents that had been passed over by whistleblowers to the FT, showing that Wirecard, indicating a Wirecard was systematically faking contracts. And then Wirecard itself, which is absurd, commissioned in April 2020, commissioned KPMG with a report which was published in June, and then Wirecard had went bankrupt. Between October 2019, when we had the whistleblower information, and June 2020, BaFin and the Ministry of Finance met 23 times discussing the Wirecard case. And what happened? It happened nothing, except from trying to the Leerverkaufsverbot. Anyone can assist.
Prohibition of short sales.
Yeah, genau. Okay. That was the only intervention they did. So I'm not saying that it is a proof of the fact that they were trying to protect Wirecard as the fintech national champion, but I think one can say that at least strongly suggests that they did so. So that's why I'm replying to this. I'm replying to a question that was asked: is it really protecting a national champion, or is it trying to winning the electorate? What government does when they're instructing financial supervision? And I'm saying that they're basically doing both. They're trying to support national champions in order to win the electorate.
Okay.
So that's it. I'm done. 6 minutes.
Great. 6.5. But okay. Thank you very much.
Thanks.
Then. Patrick, nothing to add, right?
No, not really. I subscribe to
Good. No. That's exactly what I expected.
What you wanted to hear.
Just one sentence. The idea of promoting a German fintech or a national champion, of course, in our case, falls into this category home bias and is not so much related to the idea of political career concern. So it's covered by our 3 points.
Good. Wonderful. Thank you. So, Adrienne, 5 minutes, please, to respond.
Can you hear me?
Yes.
I apologies, I can't read the chats, so I can't take issue with what's written in the chats. So I'm turning to what Matthias Goldmann said first. Indeed, what you are saying, that our argument, in a way, which we develop regarding financial markets regulation, travels as such across other policy areas as well, right? These perspectives, which I have described, which need to be fleshed out and, of course, specified in different policy areas, but in general, yes. Your second point, which you made, in a way, you said, shouldn't this entire area be more centralized like competition law, right? And leave only kind of marginal questions to member states. Here, I would say that I think the opposition of member states would be massive to bring such a decision about. Because indeed, as you know, competition law is the most centralized policy area in the European Union to begin with. And it may also be that in certain kind of substantive policy details, it wouldn't do justice to local and regional and member state specificities. So I would not support such a reform. Then as regards ISTA, that I described, you say, as a good citizen, that is a misunderstanding because I had to cut in time, right? And couldn't really present the argument in its full. It's exactly our finding that ISTA, on the surface, right, supported the legislation, the European legislation. But as soon as it came to the specification of the details of the legislation, where, you have to be honest, the expertise is just with ISTA, and it's such a complicated regulation, right? The derivatives regulation, over-the-counter regulation. And there they had full kind of, they wielded their entire expertise in the fleshing out of the details of the legislation, which meant, of course, that they could kind of, all their interests of their clienteles came to bear. In that sense, it certainly isn't a good citizen, right? Now, as what do you say about fintech? Again, there I had to cut short very much as regards decentralized authority, substantive uncertainty. And what does that mean for the regulator when it is cooperating with fintech? And it's exactly the argument which you also made. You said you get bespoke solutions, right? Regulatory solutions. You get regulatory sandboxing, a cooperation between the regulator and the fintech, which means that, of course, it's a very tailored solution to a particular fintech, which means it's a very fragmented situation, very decentralized. And if you get then, as a response of the legislator, the introduction of innovation hubs and attempts also to counteract this fragmentation in the regulation of fintechs, which is kind of spearheaded by ESMA, that is happening as a counteraction in order to bring more convergence into this very kind of patchwork of the regulating of fintechs. And as regards the point made by Michael Thiel, indeed, what we find, what we heard in the report of ESMA on the implementation of the experience of the last couple of years, what you find all over the place is the interviews with all the national regulators and supervisory authorities is there is not enough convergence, there is not enough convergence, there is not a level playing field because member states implement in such a diverse way. So they point their finger right in this particular wound and say there needs to be more harmonization, there needs to be more convergence, and how should that be brought about? That's what we are kind of facing right now as a problem. Thanks.
Okay, I see that Jonathan has raised his hand and he also wrote something in the chat to Adrienne, I imagine. And so very briefly, the question, very briefly, the answer.
Yeah, thank you. Hi, Adrienne. Sorry, I posted my question in the chat. So this is a question about how you interpret centralization at the international level and to what extent you look at what we could call the nature of the rules and recommendations produced by the international level as an influence on EU and national regulatory centralization. So if we would look at different policy sectors and different international standard setters, for example, comparing IASCO to the Basel Committee for Banking Supervision, it's often said that IASCO produces much less granular and prescriptive standards. So I don't recall from your book to what extent you discuss, let's say, the nature of the standards and recommendations, whether they are indeed granular, specific, prescriptive, and whether that what kind of influence that has in terms of how they are taken up at the European and national level.
Okay, Adrienne, please.
So what comes from the international level is not binding, right? So there is latitude in the translation into legislation, European legislation at the European level. And the argument as regards now the relationship between what is at the European level and what happens at the member state level, we argue that what comes actually as a decision at the European level as regards the standard, which is to be implemented by member states, it can be quite centralizing in its thrust. But how it is implemented then at the national level varies a lot. That was the point.
Okay, thank you very much. We started 3 minutes late. And we stopped 4 minutes late. So I thank my thanks to everybody who helped us getting towards this goal. I always know that we all have more to say, and I think that's a very good sign. So if it were now 10 minutes early, I would be worried. It's better to rush a little bit through, and apologies to all whom I interrupted, but I don't regret that. In this sense, now we have the break. The coffee break in virtual formats is quite strange, I think, but nevertheless, we leave the Zoom room open so that perhaps some exchange can emerge. I can imagine there are also questions which you still might have and which you want to exchange, but the formal program continues at 4 o'clock, and I would say that's sufficient until 4 o'clock, so we don't have to postpone this, with a keynote lecture to which we are all looking very much forward. Thank you very much.